Hello, everyone. Welcome back to another episode of the Week in Charts. Charlie Bilello here, bringing you the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment and hit that subscribe button to receive notifications for all the latest content from us. And if you're looking for a second opinion on your portfolio or your financial plan, anything financial or investing related, we do it all at Creative Planning. Reach out today at creativeplanning.com/Charlie for a free wealth path analysis. And at Creative Planning, we're located in all 50 states, so we likely have a location right near you. We're abroad as well, over 370 billion in assets under management and advisement. We're here to help, so go to creativeplanning.com/Charlie and set up a call or a meeting today. A lot to talk about. I really had a hard time narrowing down this list, but 9 important topics to discuss today. We're going to discuss the U.S. consumer, the grumpy U.S. consumer, how they're still spending. Jamie Dimon, the head of JP Morgan, has issued a lot of warnings over the last 3 years. I want to discuss those versus the return of JP Morgan's stock price and how they're doing in terms of revenues and net income. 2% inflation is a complete myth. I want to dispel that myth using some data here. More tariff deals, more all-time highs this week. Record concentration at the top of the U.S. stock market indices. Tesla troubles continue. Latest earnings report there. Google, meanwhile, continues to grow. Speculative fever is back. You've probably noticed this if you've been following the market over the past few weeks. Definitely a big surge in recent weeks and really culminating in the return of the meme stock mania. We'll discuss that. The most unaffordable housing market in history, and I'll discuss why that's the case based on the data. And we got some new data in terms of new home sales, so we'll discuss that as well. We'll end with something positive, as we always do. That would be falling jobless claims. Okay, let's start out with the U.S. consumer. The grumpy U.S. consumer keeps on spending. Here's the chart illustrating how negative the U.S. consumer is right now. Pretty negative, not as bad as a few months ago during the height of the tariff tantrum going on, but still very, very low historically speaking. The University of Michigan Consumer Sentiment Index at 61.8. And if we look back at history, it's only a few times it's been at this level or lower. You had recessions in the 1970s, early 1980s. Then you had the financial crisis and aftermath of that period in 2008, 2009. Then you had 2022 when we had the highest inflation rate since the early 1980s. And then you have today, so this year, and this is really a historical anomaly because inflation, while I believe it's above 2%, it's not as high as it was clearly a few years ago. And certainly the economy is not yet in a recession, but the U.S. consumer, very, very negative. And as we've been saying, though, over the past few months, that hasn't translated yet into them pulling back in terms of spending. And if we look at the latest numbers out of retail sales, they're still spending. So 3.5% increase on a year-over-year basis. If we adjust that for inflation, 80 basis points higher on a year-over-year basis. So very negative in terms of their outlook, in terms of their projection for inflation going forward. And that seems to be driving this negative sentiment more than anything else, their expectation that prices are going to rise. And that has not yet translated into lower spending. And if we look at the projections for the second quarter GDP in the U.S., that's very important because the U.S. consumer, over 70% of the economic growth comes from that U.S. consumer and consumer spending. And what the Atlanta Fed is projecting here is 2.4% now for that second quarter number. And what they're saying is that consumer spending is going to contribute here 1% to that growth. So U.S. consumer still chugging along despite this very, very negative sentiment. It's a very unusual situation to have unemployment rate so low, not being in a recession, stock market at all-time highs, as we'll talk about later, and yet consumer sentiment remains very, very low. But as I always say, watch what they do, not what they say. And speaking of that, let's take a look at Jamie Dimon. I just went back the last few years looking at his warnings in terms of the earnings calls because I was talking with someone the other day who was telling me, well, how can the economy doing well? Jamie Dimon's so negative. I said, if you look at his negativity over the last 3 years, it's pretty remarkable that it's been consistently negative quarter after quarter. So he's really trying to find the risks out there and identify those risks and talk about those risks. And if we look at when this started here, I started at just looking back 3 years in 2022. Of course, we were in the midst of a high inflation period then. The stock market was in a bear market, but I just want to read his comments back from the earnings call back in 2022. Significant headwinds immediately in front of us, stubbornly higher inflation, uncertain impacts of quantitative tightening. So the Fed was doing QT, the war in Ukraine, and fragile oil supply and prices. Again, in early 2023, when really the stock market at that point was starting to really recover, still accentuating the negative here. We do not know the ultimate effect of headwinds from geopolitical tensions, the vulnerable state of energy and food supplies, persistent inflation, unprecedented quantitative tightening. In April of 2023, he wants to caution against jumping to super positive conclusions. There should be some significant normalization. Trade uncertainty, high fiscal deficits. He's talking about the risk of recession in early 2024, a number of uncertain forces in April 2024, persistent inflationary pressures. Now we got to go to July 2024. Tail risks, geopolitical situation remains complex and potentially the most dangerous since World War II. Inflation and interest rates may stay higher than the market expects. October 2024, conditions are treacherous and getting worse. There is significant human suffering, and the outcome of these situations could have far-reaching effects. We continue to face two significant risks. This is in early 2025. Persistent inflation due to ongoing and future spending and complex geopolitical conditions. April of 2025, so in the midst of the tariff situation, the economy is facing considerable turbulence with the potential negatives of tariffs and trade wars, ongoing sticky inflation, high fiscal deficits, and still rather high asset prices and volatility. And that brings us to July, his most recent comments. Significant risks persist, including from tariffs and trade uncertainty, worsening geopolitical conditions, high fiscal deficits, and elevated asset prices. So consistent across the board last 3 years, not really talking much about the positive and really identifying risks. So then I want to talk about, well, how has JP Morgan's stock done over this period of time? How has the company done? Well, it's done tremendously well. You can see here looking at their revenues and profits here, record revenues over the last 12 months, 175 plus billion dollars in revenue. You can see the huge growth spurt over the past few years. Net income, it's the most profitable bank in the world at 56 and change in terms of net income. And the stock price here, you can see last 3 years during all of these comments that were being made, up and to the right, stock's actually at a record high, up 181% over the last 3 years versus a 68% gain for the S&P 500. And as I talked about last week, JP Morgan Chase now an 800 billion market cap, which is bigger than its next three competitors, the next three largest banks in the US combined. So just an astounding performance for the stock, for the underlying company. But CEO Jamie Dimon still negative. So very similar to the negativity in terms of consumer sentiment, does not really follow what consumers are doing in terms of spending. Jamie Dimon's negativity does not reflect how JP Morgan Chase is doing or how the actual US economy is doing, or obviously the stock market, as we'll talk about in a bit. 2% inflation is a complete myth. I want to talk about this once more. Last week I showed you this chart. I'm showing it again here. 4% annualized inflation since the beginning of 2020, when the Fed really went crazy doing their monetary stimulus, printing money, driving up that inflation rate or helping to do so. We also had the massive deficits in 2020 and 2021 really doing that as well. And so we've been averaging double their target. So I got a lot of comments saying, well, you're really just picking this period since January 2020. What if you looked at other different time periods? What would that show? So I'm definitely going to show you that in a second here. But just looking at the last 5 years and the huge increase in prices across the board, if you're looking at groceries, up of 23%, health insurance, 24%, restaurants. So if you're eating out to dinner, you probably notice prices are much, much higher, 31%. Transportation costs, 47% higher in the last 5 years. Utilities, so just your average utility bill, up 56% over the last 5 years. Mentioned auto insurance last week, but just got to say it again because 75% increase the last 5 years, just absolutely insane. And egg prices have come down so far in the past few months, but still up 143% over the last 5 years. So none of this to me looks like anything close to 2% inflation, even if the last year inflation has come down to 2.7%. Well, it's the cumulative increases that really matter for people. And just drilling into different time periods here, what I did was I looked back the last 13 years, and I picked 13 years because that's when the Fed started with their 2% inflation target back in 2012. So over the past 13 years, inflation, if we're just looking at US CPI, overall inflation, 2.7% per year. So well above that 2% target. And you can see here, obviously, the last 5 years, 4.6% per year, so much higher than that target. Over the last year, yes, it's come down to 2.7%, but to me, none of this looks like 2% inflation, which is why I continue to argue the Fed should not be easing here. They should not be cutting interest rates until we get back to that 2% target on an average basis. So if you're going to have a target, you should stick to it. You should adhere to it, or you should raise your target. So if we're going to say inflation should be 3% per year, well, then that's a different discussion. But as long as your target is 2%, they should have prices average below 2% for a period of time to bring this overall average down to 2%. And in terms of the next Fed meeting, which is coming next week, the market is pretty much saying no chance of a rate cut, which I think is the right thing. They shouldn't be cutting rates right now. 97% probability of no change. But interestingly, the market is still very much expecting the Fed to ease at the September meeting, 25 basis points, and then again at the December meeting, another 25 basis points. I don't know if they'll actually do it, but the market is still pricing that in, and we'll get a lot more information next week when the Fed does their announcement. And my thought is Powell will probably start to telegraph a potential cut in September if that's what they want to do. But the evidence on the inflationary front really not indicative of a 2% inflation rate. If we're looking at the unemployment situation, still very low. To me, that would favor still worrying about the inflation side and keeping monetary policy restrictive until prices normalize much more than they have. So if we're looking at 2025, markets betting 50 basis points, and then 2026, and we know Powell's term is set to end next year, the market's expecting 3 more rate cuts in 2026. So certainly the market is not pricing in what I'm suggesting whatsoever. So they're certainly not listening to my argument. They're saying that the Fed is going to continue to ease monetary policy, and they're going to start doing that once again in September. A lot of data between now and then. Of course, this could change, but this is the expectation as of now. Okay, let's go on to tariffs here. We got some more deals in the past week at more all-time highs for the stock market. If we look at Indonesia, they're talking about a 19% rate to start August 1st. Philippines also at 19% rate. Both of these are lower than the higher threats that were threatened earlier, 32% for Indonesia, 20% for the Philippines. And then Japan was a big one here, was 15%. I think it surprised people that it was that low because just a week earlier, they were talking about 25% potentially. So across the board, seems like lower than the initial targets in terms of what the White House was projecting. People were expecting it to be lower, but I think the markets received it so far as being definitely good news. It's interesting, the Japan deal, in terms of trade here, you had objections from the Detroit automakers, so the big three, General Motors, Ford, and Stellantis, the Chrysler parent, all objecting to the trade agreement, saying it's giving Japanese imports an unfair advantage over American-made vehicles. Let's say they're making it in Canada or Mexico. Well, they'd be paying a higher tariff rate than what Japan got. Also, you have to factor in the fact that there's tariffs on steel and on copper. And so even if you're making it in the US, potentially you could be paying a higher price than if you just import that car fully made in Japan. So interesting argument there. I haven't heard that they're going to change any of these policies, but we still don't know, I guess, where it's going to shake out in terms of Mexico and Canada, in terms of their tariff rates, and what's going to happen with steel and copper. All of that remains to be seen, but very interesting to see the Japanese stock market significantly rally after the announcement of this deal. So certainly reviewing it as a positive for that country and for the profits of Japanese companies. And if we look at Toyota Motor, I just went back 10 years here on this chart, but showing you 13.6% increase in the stock the day after this deal was announced. So certainly investors betting this is going to be good news for Toyota in terms of increasing its sales potentially to the U.S. consumer. So this was one of the biggest one-day moves in the history for Toyota stock, not a small move whatsoever. So if we're looking at where the effective tariff rate is right now, I still point out this is from analysis of the budget lab at Yale, and they're looking at just all the deals that have been done and everything else where it stands today. The effective tariff rate is about 20%. That's up from 2% entering the year. So still would be extremely higher, even though it's come down, let's say, from what those initial Liberation Day tariff levels were. 20% still very high, and it seems clear, judging by the deals with Japan, with Vietnam, with all of these countries, that going back to a single-digit rate doesn't seem likely in the near term. So this would be the highest rate, if this sticks, since the early 1900s in the US. A huge shift that's obviously going to have ramifications. The question is, well, when are we going to see it in terms of prices? Who's going to bear this cost in terms of this increase in the tariff rate? Well, who's going to bear it? Is it going to be the exporter internationally? Is it going to be the importer, the U.S. company importing it? It's going to be the U.S. consumer. It's going to be likely some combination of the three. So tariffs, at the end of the day, are a tax. We're getting some revenue in terms of the government. I'll talk about that in the next video. In terms of this tariff, it could be as high as $300 billion at the current rate in terms of the revenue we're receiving. But the question is, well, who's going to bear that cost? Is it going to be the person selling the good overseas? Is it going to be the U.S. company importing that good, or is it going to be the U.S. consumer? And I think we're only at the very beginning of seeing who's going to bear that cost and what the potential impact is going to be, because this is just such a huge increase in a short period of time. And as I keep mentioning, companies really front-loaded this increase, so they bought so much in the first quarter of this year that it's going to take time. And it's only when they're replenishing those inventories that we're actually going to start to see this impact on, in terms of profits, in terms of the cost, in terms of prices. So we're just starting to see that now. It's very minor so far. I think GM is talking about $1 billion hit, but so far it's very small because of that huge front running of the tariff in the first quarter of this year. But in terms of financial markets, the stock market couldn't be receiving it, I think, any better than it has been. This is showing 13, but as I'm talking on Friday, I believe it's going to hit the 14th all-time high of the year. And every day this week, that would be 5 for 5 in terms of all-time highs. Just stunning move higher for the S&P 500. Really assuming the best in terms of these tariff deals that have gone on, and the potential for future deals that haven't yet been announced. And in terms of the global stock market, I think this is probably even more surprising and unexpected. If I would have told you that global stocks would be outperforming the US by such a wide margin, given these uh, uh, tariffs that are in place, you would probably say that's crazy. Why would that be the case if supposedly the tariffs are to help the US and help US companies and help in terms of the US economy? Well, why are these global stock markets doing so much better? That's an interesting question. Could be a number of reasons for that. Obviously, the valuations of these international stocks were much lower than the US coming into the year, but it's just fascinating to see. Certainly, the market is not betting that these tariffs are going to cause a hit to profits in terms of global corporations. That doesn't seem to be what's being priced in at all. If we look at the Eurozone, up 30% now in terms of the Eurozone ETF, international ex-US up over 20%, emerging markets close to 20% now. And if we look at the US here, still in the bottom third of countries, but certainly not a bad return whatsoever, up about 9% on the year total return. So very few companies in the red, and many of these countries having just enormous, enormous gains. For at this point, we're not even at the end of July, and we're talking about Poland and Greece up over 60%, and many of these countries very strong, up 20, 30%. Just huge, huge advances, I'd say. Definitely, if I had showed you this chart of the tariff, nobody would have predicted this table here showing these huge equity returns around the world. And if we look at the major asset classes here, once again, all of them in the green. So everything from long duration treasuries at the low end to gold at the top, and everything in between, all positive now in 2025, with, you can see here, global equities beating US equities, emerging markets beating US equities. That hasn't happened in quite some time to this extent. So a big gap still with outperformance internationally, but everything really doing well. So credit doing well, high yield bonds outperforming with credit spreads tightening. See commodities are positive, investment grade bonds, and small caps still underperforming, but now positive on the year. So it'll be interesting to see the last few months of this year if we're going to build on these gains or we're going to see another correction potentially. It's unusual to have such a smooth market following such a big decline just a few months ago, but here we are. The VIX right now, as I'm looking at it, is trading around 15 with the potential to close below 15 on the week. We haven't seen that in a few months. So market behaving as if all news is good news, and the ultimate resolution of all of this tariff stuff will be positive, not just for the US, but for the rest of the world as well. And now you just have to say, well, is that a right expectation? Is it wrong? Is the market being overly optimistic? We shall see. As I talked about last week, valuations definitely on the optimistic end, well above their historical averages. So let's talk about record concentration at the top of the US indices. We look at the S&P 500, Nvidia close to an 8% weighting in the S&P 500. That's the biggest for any single name in the S&P 500 with data going back to 1980. You could see at various times different companies have been the biggest stock at 6.4% IBM in the 1980s. In the 90s, you had Microsoft at 5%. The 2000s, you had ExxonMobil at around 5%. And then that was exceeded by Apple, 7.6% at the end of last year. And now Nvidia surpassing that, close to an 8% weighting, highest of any single company since 1980. And then if we look at Nvidia and Microsoft combined here, really the duo driven by AI growth, 14.9%, biggest for any two companies. So previous to this, it was Apple and Nvidia at the end of last year, and now Microsoft surpassing Apple, and the two of them combined almost 15% of the index. So very, very concentrated at the top. If we look at the top 5, top 10, those are setting records as well. So what that means is if you just buy the S&P 500, you're more and more reliant on these biggest companies, which would suggest to me that you want to have diversification outside of just the US markets and just the S&P 500 just in case this situation were to change. So you've benefited from it for sure, right? If you've had this large cap US exposure, you've benefited from the outperformance of the Magnificent Seven names, but there's a risk, of course, the future looking different than today, and just buying that index, just mathematically, you're more reliant on these few companies at the top, which means you're not as diversified in the S&P 500. You're less diversified today than at any point in the last 45 years. So let's talk about some more earnings here. Tesla troubles. Google continues to be a growth juggernaut. Tesla here, revenue down 12% year over year. Not a huge shock. We talked about deliveries going down a few weeks ago, so this was definitely predicted, but 12% decline was the biggest decline for Tesla since 2012 in terms of its revenues. You can see here, automotive revenues were down 16%. Yet services actually going up, so the overall revenue decline was lower than the 16%. But in terms of their main core business, the automotive business, really still struggling, down 16% year over year. Operating margins continuing to compress here, 4% operating margins. They were 6% a year ago. And if you go back a few years, they were double digits. So definitely a hit in terms of margins. And if we look at net income, down 16% year over year. And the net income number for the second quarter was the lowest for the second quarter for Tesla since 2021. So Tesla obviously having a difficult time here. We'll see what happens if they can turn this around, but definitely looking much different than some of the other Magnificent Seven names like Google, which continue to just show tremendous growth, 14% year over year in terms of their revenue. They had their best second quarter for revenue and net income in history. And if we look at the projections for Google's revenues for this year, over 390 billion is their projection, which would be up from 350 the year before. And just look at this trajectory here, unbelievable. Over the last 5 years, last 10 years, more than 5x in terms of the revenues. And they were a big company 10 years ago. They were doing 75 billion in revenue, and now we're talking about 391 billion. Just stunning, stunning growth. And I posted this on X. I thought this was pretty interesting. YouTube, in terms of TV viewing, so looking at watching your TV, more and more people are actually watching YouTube on their TV, and now it's the biggest share in terms of viewing time. It's over 1 billion hours per month. You're talking about 12.5% share here in terms of YouTube, which is now bigger than Disney. So YouTube, number one thing people are watching on their TV today, and you can see how that compares even to NBC, Paramount, Netflix, far above that. And that's definitely helping Google's top line and bottom line as well. You can see here YouTube ads coming close to 10 billion in revenue. It's up 13% year over year. Their Google search business still chugging along, 12% increase year over year. So a lot of fears in terms of what Chat GPT and all of these other AI models are going to do to Google's search revenue, but it doesn't seem to be hurting it just yet. Still 12% increase, pretty good over the last year. And of course, Google's cloud revenue continues to grow at such a tremendous pace, definitely beating expectations there. 32% increase in terms of their cloud business in just the last year. And you can see here in terms of operating income, 11% increase for Google services and 141% increase for Google Cloud. And so very profitable business there. And as I talked about last week, there's a big divergence so far this year in the Mag 7 names. It's not like the past few years where they're all moving in tandem. Google, despite its strong performance here, still underperforming the S&P 500, up about 2%. NVIDIA, you can see Meta and Microsoft far outperforming, all up over 20% on the year. And Apple and Tesla, you can see at the bottom here, Apple down 14%, Tesla 24%. Not a huge shock given what I just talked about in terms of earnings. So we have a lot more earnings to come. We'll see what happens when we get Apple's number, Amazon number, the other big players here. All will be important to see how their results are faring. And of course, the big focus is going to be on AI, the investment there. I think the big stat coming out of the Google call was that they're going to spend now $85 billion in the next year on capital investment. And what that means is a lot of it's going into that AI. So that was 10 billion more than expected, which was around 75 billion. So a lot of money being spent in it. NVIDIA continues to be the biggest beneficiary of all these other big players spending money on the AI arms race. But the question is it going to start to accelerate the profits of these other companies as well? And that seems to be the bet that they're making. So they're not making this huge investment for nothing. They're betting that it's going to lead to huge profits in the years to come. Okay, let's talk about speculative fever is back here, the meme stock mania. Every time you think it's done, it comes roaring back. And new twist is this time a whole new host of names. I don't really know how this originates. It's, it starts probably on a message board somewhere and just starts to build and collectively becomes just a crowd rushing into a single name. Many of these identified as high short interest. These are companies that, generally speaking, are struggling. I'll show you the fundamental data there, but for whatever reason, and I don't think it occurs in a vacuum. So the fact that the stock market's hitting all-time highs, volatility is low, you have just a risk appetite off the charts, running wild, FOMO is back into the market. All of these reasons are why you see the meme stock mania come back. It never occurs during a bear market. So in April, no one was talking about making these speculative bets on meme stocks. But here we are with the markets hitting new highs. Investors, I wouldn't even call them investors, speculators, just look for something. They're looking to take more risks. So it's not enough to say, oh, the market's doing well, it's hitting new highs, global stocks are doing well. They want to take even more risk than that because the view is there's very little risk. And we know that's not the case. There's actually more risk when the market is elevated versus when it's down. But the average person saying, I want to take more risk here, and they hear something like a meme stock, they think about the short-term move that it's making, and I'm just explaining that's why people are rushing into it, the fear of missing out and the idea that you can make a quick buck trying to trade these things. So Kohl's, Open Door, a whole new host of names. I'm just going to run through the charts here. You can see what they've done here. Open Door Technologies, you can see up and now back down, but still higher. Kohl's, same situation. Spikes, comebacks down. GoPro, all these charts look alike. You just have this huge rush in, down. Nobody knows, will you have another rush higher? Is it gonna go back? But rocket companies, Krispy Kreme donuts. Again, it's just hilarious to see the names that people pick here. And what we're talking about is such a big increase in speculative activity that you have the options contracts, the volumes of these things on Open Door actually exceeding NVIDIA. So NVIDIA's biggest company in the world, $4 trillion in market cap, and a tiny company like Open Door is actually has a higher value of the options contracts. Obviously, that doesn't make sense. It only will occur in this type of situation where so many people are speculating on this name. And I just pulled up the fundamentals of these to illustrate that none of this is going on because people are betting that the companies are going to improve, that they're going to produce more earnings or free cash flow. I just pulled up the most recent quarter for all of the recent meme stock names. Beyond Meat was an old one, but I guess it's now in the new craze as well. They had a negative 31 million in terms of free cash flow. Krispy Kreme, negative 47 million. GoPro, negative 58. QuantumScape, 67. Negative 116 million for American Eagle. Kohl's, negative 202. Open Door, negative 283. And Rocket, negative 867. So needless to say, these companies, similar to GameStop and AMC, fundamentals not very good. People don't care about the fundamentals. All they're looking for is to try to time this move higher and lower. Needless to say, most people won't time it well. Many people are going to lose the money jumping in and out at the wrong time. So if we look at GameStop and AMC, for some reason they're not part of the recent meme stock mania craze. Maybe that'll happen next week, but this is just a warning to anyone thinking that in the long run this is going to work out. So there's this concept of diamond hands that they coined back in 2021, which is to say, well, you should never sell, you should just hold on. You can see that's not a very good strategy for a company whose fundamental business is in decline. So you can see GameStop down 73% off of its high, all-time high, and AMC is actually down over 99%. And unless the fundamentals of these companies improve in the long run, you're not going to see a huge advance. In the short run, anything could happen. But betting on just a greater fool and betting on being able to sell it at a higher price because other people are going to be jumping in after you, that's a very difficult game to play. I wouldn't recommend it to anyone. Okay, let's talk about the most unaffordable housing market in history here. And new single family homes for sale. This is very interesting. We saw another increase in inventories over the last month. So this is for June, 511,000 now of new homes for sale in the US. That's the highest inventory since October 2007. So you got to go back to right around the peak of the last housing bubble to find inventories this high in terms of new homes. And why are inventories so high and rising? Well, they're having a hard time selling these new homes because the prices are so high and people can't afford them. So what they're doing very slowly is cutting prices, offering more incentives, but that's not enough to sell more houses because still that affordability comes into play. So they definitely are selling homes, and they're definitely selling smaller homes because smaller homes are cheaper, but that still is not enough to counteract this force of higher inventory because that unaffordability is just so high here. And so what we've seen actually over the past 3 years, this might be surprising to some people, but we've actually seen a 13% decline in the median sales price of new homes in the US. So you're probably still hearing existing homes are hitting record highs. Not the case in the new home market because the inventory picture is much different, much higher for new homes than existing homes. I'll show that chart on the next video. But back in the last housing bubble, what we saw was an over 20% decline in terms of the median sales price. So is this a huge decline, 13%, given the run-up that we had? Not at all. Does it make houses affordable? Unfortunately, not at all. So you need to see much lower prices, or you need to see people's incomes go up, or you need to see mortgage rates come way down to really improve the affordability picture. And I just want to show this chart. It's so stunning here. Now, over 50% of your income would be needed for the median household to afford the median priced home for sale in the US. That's a record high, well above where we peaked during the last housing bubble, which was at 44%. So it's an untenable situation. It should not be this high. Nobody should stretch and try to spend over 50% of their income to buy a home and to afford the taxes, the insurance, the maintenance, everything else, the interest costs on your mortgage. It crowds out everything else in terms of spending. So this is not a good situation. The solution, of course, is lower prices would be the easiest solution. Is the Fed and the federal government going to allow prices to normalize? That's the big question. I'm not sure that they will. Again, they're calling for interest rate cuts here. They're not really warranted. And they're trying to say that's good for the housing market. I don't see that as good. That's just going to add more demand in terms of the market, and prices will go up. You have to let the housing market become affordable based on people's incomes. It's simply not at that case, the situation today. And the reason why we got to where we are today, the reason why home prices went up so much is because we did this artificial stimulus. We pushed rates down so low in terms of the Fed, pushed them down to 0%. They bought trillions of dollars in mortgage bonds. They made the interest rate an artificial level in terms of the 30-year mortgage at 2.65%. So, of course, that created just a flood of demand, drove up prices. So let's not compound that problem by starting to cut interest rates too low, too quick here before the housing market normalizes. So if you let supply and demand work here, supply will continue to increase until you have prices at levels where people can afford them. Same thing is going on in the existing home market. It's just taking time because of the lock-in effect, because of all of those people who locked in mortgages at low levels. But eventually, you will see a normalization. I think we're just at the cusp of the start of that. So hopefully, we'll see that in the next few years. Housing affordability improve. That is what the goal should be, affordability, not what we've been trying to do during the last two housing bubbles, which is pump up the prices to artificial levels. Not good for anybody. It's really not a strategy that you want to have as a nation or a Federal Reserve. You want home prices to be based on people's incomes, not based on artificial money printing and ultra low interest rates, which are not sustainable. Because once you take that out of the market, well, then you have the reality, oh, prices are not reflective of people's incomes. Now they have to reset, and that can cause problems in the broader economy. Okay, let's end with something positive, as we always do. That would be falling jobless claims. So I've been highlighting this as a risk. About a month ago, it had been trending up. These are people filing for unemployment, had been trending up highest levels since 2023. And this is a leading indicator for the jobs market. So if it were to continue in that direction, I said, well, this is potentially an indication that the jobs market is really starting to slow. That could be a warning sign. And what we've seen over the past month is just an about face. We've seen it move markedly lower. What I'm showing you here in the lower panel is the continued jobless claims. So people who are still filing for unemployment insurance, and that just ticked lower. It's a week behind in terms of the data that they report for this, but that would be a good sign as well. If people are starting to find jobs that have been unemployed, that would be a great sign as well. So hopefully this trend continues and we get a positive payroll report for the month of July. When we get that report in early August, hopefully that's the case, because as long as people have jobs, the economy will continue to grow. People's wages, as I talked about last week, are finally been outpacing inflation, which is a very good thing and why we need to keep inflation low. So all of those trends are positive. And if we have jobless claims going down, that means layoffs aren't very high, and that's a great thing as well. So hopefully this trend continues, jobs market remains strong, and we'll end it right there. Thank you everyone for joining me on the Weekend Charts. Have a great weekend, and I'll see you next time. If you're watching this on YouTube, remember, hit that subscribe button for all the latest content from us.